All right, so you want to know how to backtest, am I correct?
Yes.
Okay. So my idea of backtesting, which I've been doing all weekend, and it's kind of like my video game, and you have to kind of see it that way if you play video games because it
Mhm.
becomes your passion. So I use backtesting over the weekend because you can't really trade, in real time unless you're trading crypto. So you can kind of watch those markets for also backtesting too.
Mm.
To watch the crypto markets. So that's one way that you can back test in real time over the weekends without actually having to use any money, because obviously on the weekdays we're bored. I mean, we're at work and we're busy, we gotta eat dinner, get ready for bed and all that. So, but if you're not doing that, there's other things you can do by looking at the charts in order to the back test. So, first, when you come to back testing, you want to have your favorite stock. So you want to have the stock that you love to trade. Everybody has this favorite stock they always want to trade all the time. You should have at least like 1 to 5 stocks that you like to trade all the time. And you have to do your homework on those stocks because you have to make sure that it fits your account size. If you
Yeah.
see me trading Amazon and Tesla, you obviously can't trade that if your account size is smaller. So you can't just force it, because if you force that trade into your account size, no matter what, you're only going to not only be trading 50% to 100% of your whole portfolio, but that's incurring extra risk you don't need to. So you want to try to find a stock that works for you so that you're only trading a percentage of your account. So in examples after this, I'm going to go with MU because MU is in a stock that is $100 to $200 per contract and is very cheap and everybody can afford it and it moves. So choose your favorite stock that fits your account size and make sure that stock is volatile. My son started trading,
Mhm.
18, he put $500 in there. He's like, okay, what can I trade with? And I was like, well, I'm gonna give you a watch list of 100 of all stocks that are under $100. But just because they're under $100 doesn't mean you still can afford it with a $500 account. Then once you find all the stocks that are cheap, now you have to look at all the contracts of each of them and find out how much are they about. Because some stocks, even though it's a $20 stock, it could be $500 to trade it. A $20 stock could be $50. So it all just depends on the volatility of the stock, on how much that stock is.
And the volume too within that one contract, right?
Right, right. The volume, the open interest, all of that matters on how the valuation of the stock, how the stock's valued on the contract. So you have to do that homework too. And you don't want to waste your time back testing. And the reason why I'm talking about all this, because you don't waste your time back testing a stock that you can't even trade.
Mhm.
Why back test Amazon if you're never going to trade it?
That's
So
true.
you might as well back test something you're actually going to trade. So that's why I got that as number one. Is like find your favorite stock for your account, make sure it's volatile, make sure it moves. Because you can get 8 stocks and be like, okay, all these stocks fit. But when the trading day is happening, all those stocks are going sideways while all of the big caps are moving up and down hard. Then you're like, well, I'm trying to trade, you know, Home Depot, but it's not moving, or Walmart. Well, that's because no money's moving. There's no volume moving into that stock. Everybody's focusing on these other stocks. So just because you can afford it means it's not a good stock to trade. Okay. All right. Number two, I like to do multi-time frame analysis, and there's different ways to do it. So that's a top-down approach. So you start at the daily, go all the way
Mhm.
down to the 5 minute, 1 minute, and you're just looking at different looks. It's kind of like zooming out in space, looking from space and then coming closer into the earth, all the way down to you're at ground level. And you're seeing what's actually happening on the ground. But if you zoom out, you can see a bigger picture of what's going on in the market, what's going on with the stock that you're trying to trade. So you can get a way of doing a multi-time frame analysis. You can kind of see, engage where the stock could potentially go up or down, because that's all that really matters. Is the stock going to go up or is the stock going to go down, right? So there's ways you can do multi-time frame analysis based on support resistance, SR,
Mm.
support resistance. That's where I kind of look back past data and I kind of see when was the last time that this stock hit a support level, and when was the last time it hit a resistance level. Okay. Then another
Okay.
thing I do when I do my multi-time frame analysis is I look at the EMAs. We were in voice chat together. We're big on EMAs.
Yeah.
So I like to see when's the last time that the stock bounced off 200 EMA, 400 EMA, 50, 100. When at what point is it bouncing off the 21 EMA? You know, you got to know that stuff, and what time frames. So you're doing your back testing on MU Micron Technology. You know that this particular stock always bounces off the 21 EMA. And if you can kind of gauge and try to guesstimate if it's going to bounce off a 50 or 21 or 100, 200, 400, then you can enter the stock a little bit early and get that options price cheaper. So, because when a stock already bounces and is headed back up, those options premium contracts are already increasing, right?
Yeah.
So you're already starting to overpay as the price continues to go up. But imagine you buy that. Say what?
Sorry to interrupt, but same thing goes for the reverse, right? So let's say if you have a contract, and you start selling it, like as the peak is going down, your contract becomes less valuable, correct?
Exactly. Same thing goes for the reversal too.
Okay.
If you could figure out when the last price is going to reject, whether it's a previous resistance point or rejection off an EMA, you can enter a put right before it reverses, and you're going to get it cheaper. And then as it's going back down, you're like, yes, I'm right. Your profits are going to accelerate even faster because you got in earlier. Yeah. So you just want to capture that big move. All right. Chart pattern recognition. Obviously, you want to set up for these big plays. So as you're doing your analysis on your favorite stock, then you want to start drawing your chart patterns. That kind of gives you the setup point of where you can enter and exit trades based on breakouts of these patterns. And then finally, you get the RSI MACD strategy, which is momentum strategy, using these as a guide as a momentum up or down. You don't use it to actually enter trades. Use it to figure out the momentum because they are lagging indicators. Okay. So here I got the Micron Technology chart up, and we'll start out at the daily. Okay. So here
you start at the daily, or can you work your way up from like 5 minute all the way up to the daily?
You can work your way up, or you can start from the top and work your way down. We commonly like to start at the top and work your way down, and then you want to get the most guesses of which way it's going up. Like if you look at the daily, you saw back here, we're talking about EMAs here. EMAs, you see that this bounced off the 400 EMA.
Yep.
This is the pink line, and it went all the way back up. And then as it was dropping, you could see that it bounced off the 21 EMA, which is the orange line. It came to, and when it broke out again, and eventually it fell below, and then it starts bouncing off the 200 EMA, starts bouncing off the, it fell here below, but it reclaimed the 400 EMA, kind of been going sideways ever since.
Yeah.
Right. So looking at the pass of structure, so you can draw your levels here, and some people like to draw just a straight line, or you can draw like a zone. So you know that the price of this candle is currently here. So you're looking for the next big support area based on the past. So you have this point right here, and you have this area in here, okay? So, and you want to draw from the bodies to down to the wicks, and you basically want to touch like the majority of the area, okay? So you notice how it bounced off here, but why? You're like, why did it bounce off here? Well, if you look back at the past data, you'll notice how there's a trend of a bounce. You see this area where it bounced here?
Yeah.
And then it came down, it fell a little bit below, but it reclaimed all in this zone. So this is called the demand zone. So you can get an idea that, hey, this stock could very well come back down here. So that's big, strong level of demand down here. Also, you can look here, even closer data just over the past week.
You got that gap right there?
I don't see a gap. Oh yeah. Well, this gap, this gap right here. Yeah, you're right. There was a gap, but you're talking about gap fills now. Yeah, that's like a whole nother strategy.
Oh, okay.
And it's also something to consider. Yeah, there's a gap way down. At some point, it has to get filled, and I don't think it officially got filled yet. Yeah, I see it's missing out a little bit. The gap fills down at 73.54, 53, 73.53. Yeah. So with that in mind, you can also, take that into consideration that the price could fall to gap fill and then bounce. So, but these are strong support areas. So if you look back at last week where it bounced here, look at previous where you see this wick bounce here.
Yep.
There was a move up, down, up, and it kind of built support here, and this level then skyrocketed. So same thing goes for resistance. You got to mark your resistance levels. And some of the you see some of the analysts and people, they like to do the same supply and demand zones, and they like to mark them up and everything like that. So you look at, there's a gap fill up here, right?
Yep.
There's a gap fill up to the top at 88.39. So you got a gap fill to the bottom, gap fill to the top. So it just gives you a general idea of what probably needs to happen in the future. They say that gaps fill 90% of the time, but when, that's still to be determined, right?
Yep.
But you can draw here at these big areas of supply zone that the price eventually will have to get down here. Okay, so that's looking at the daily. Then you want to drop down to 4 hour and you kind of get the same gauge. Hey, there's really no change. Actually, I could probably draw a supply zone up here now. You see that? Most current data supply zone is in this area. Okay. So we're looking at this area. Let's drop down to the hourly. So I'm just going down from the daily 4 hour. Now I'm down to hourly. So the hourly is like one of my favorite time zones, time frames. I really like the hourly because you can use this to enter for day trades or swing trades. So it's like the pivotal point of where you can decide if I'm going to be day trade or I'm going to swing trade this based off this data right here. Okay. So it's good. The 1 hour, I like it. So on the 1 hour, you can also start, as we're going down in time frames, you're finding other levels of supply and demand. Okay. You see, we already drew those on higher time frames. So now you can draw that this was yet Friday's demand level. Okay. And you can color code it a lot differently if you want. So you know that this color green is going to be higher time frame demand, supply and demand zones, but then you're going to get into the hour and below. You can start marking up supply and demand zones for the small time frames. So you got this demand zone here, and you have this up here. So the price will go up, the price will go down, and ultimately this is the last point of where the price hit and then fell back down. Okay. So that's doing back testing to figure out where the stocks are going, where it's moving to. And when you and you keep going down, and then pretty much that's all you have to worry about. So as you go down lower time frames, there's not going to be much else you've already marked up. So even though it seems like a lot to do top-down analysis, it really isn't. You're just doing like daily 4 hour, 1 hour, and then it basically takes care of the rest for the night. And then when it comes to entering an actual trade, now that you know where the price could go, an illustration of where it can go, it could fall, then now you want to trade the breakouts of these areas. Okay. So you know that even closer down here, this was daily demand zone, right? Was that daily? Yeah, that was a demand zone. Oh yeah, closer to close data demand zone. The demand zone's way down here also, but we definitely don't want that to fall. If we do, we definitely have to buy puts. So if this is the demand zone of closer data, you want to buy calls when it breaks out of here to the side. So you know that based on my back testing, I found that this is higher time frame zone area. So if it breaks out of this zone, I'm going to buy calls in hopes that it will go up to this area. Okay. If it drops below, you're going to buy puts down to this demand zone area. You got any questions so far?
Confirmation of calls. How do you tell? It's like, how do you confirm that like it's not a false breakout,
So when it comes to like false breakouts, they will happen. You have to understand how the market moves. And in order to understand the false breakout, it's all about like the structure. So if we go to do, let me find it. So are you familiar with Elliott wave theory?
Yes.
Okay, so 5 count impulse wave up, ABC correction down. Obviously, you can reverse it, but as the stock's moving up here, this is what you want to see, because nothing really goes straight up or straight down unless there's some big catalyst news. Okay, so as long as the stock is keeping its and maintaining this move up, like in these wave formations, you know, you can stay in, because there's also going to be EMAs that are going to come across and they're going to bounce off the EMAs. So, but you know, it's a reversal and a false breakout if it breaks out of this demand zone here and moves up.
Yep.
And then if it moves down 50% and bounces, you know, you're good. But it's a false breakout when this move drops back below your entry point. The move falls back below your entry point, you could just cut it really fast, and then you lose minimum. It's when you start letting it come all the way back down, and then now you're hoping and praying that it's going to go back up, when really you should like, oh, I should have just cut it, right?
Yeah.
I should just cut a long time ago. And now you got this move going up, down, up, you know. So false breakout is below your entry, or as it breaks out and it drops 50% below, then likely in options you're not even profitable, be even more, even though the price is higher, higher than your entry. So, and that's just looking at structure. And I always look at this all the time. Every time I enter, every day I'm always marking out when everybody's making a watch list, they're always making a watch list based off the previous day's supply and demand zone, previous day's move. Oh, okay, previous day moved here. I'm going to buy calls above this level, and then I'm going to sell it when it gets back up here. That's so common. Or I'm going to buy puts below this level here, and I'm going to sell when it gets down here. So everybody's looking for the double top, the double bottoms, you know, the triple tops, triple bottoms. And that's when it comes to like chart pattern recognition that we'll talk about later. Okay. If you add in there EMAs, then that's another gauge of how the stock rises or falls. Say, hey, I'm going to buy the breakout of this 200 EMA, and I'm going to sell when it hits the 400 EMA, because we know that last time, based on past data, look what happened. Rejection, rejection, rejection. So what can you assume what's going to happen when this goes up to the 200 EMA again?
Most likely rejection. Most
likely rejection. So you have to consider what's the fact. It's fact right here that this price rejected off the 200 EMA. It rejected 200. It rejected off the 200 EMA. It rejected off the 200 EMA. Okay. Here, back here, a while ago, a couple of days ago, rejected off the 400 EMA after trying to come back up. That was a false breakout. Okay. It came down. We were anticipating a bounce back up. It went back up here, and then it fell back down and dropped. So this right here is an example of a false breakout. But you have to recognize it's a false breakout, and you have to get out and then reverse and buy puts. So if you're in calls here and it reverses on you, you just have to recognize that this is not working out. This pattern is not working out. This structure is not working out, and it broke down below. And that's what we're talking about, chart pattern recognition. You're constantly drawing your charts, and you're constantly redrawing your charts, okay?
Yeah.
Redraw your charts. Look at different ways. You'll notice here that this is descending triangle, which likely is a bearish chart pattern. If it breaks down below, you can buy puts here. You see that?
Yep.
Okay, so always redrawing your parts. So always consider supply and demand zone where the price was previously. Always consider the EMAs, because the price rises and falls off the EMAs, and always keep drawing your patterns, and then you'll be good to go on doing back testing. At least you know now that at this current moment in time, the MU is always rejecting off the 200 EMA. Now, what happens when it breaks out of the 2 EMA and of the 200 EMA and then establishes support?
It'll be bullish now, or?
Yeah, it'll be bullish. So it'll come up here, a breakout, it'll come down.
Test it.
Yeah, test it, and it'll come back up. Now, if it comes back down here and drops below the day's open, then it could be a reversal and go back down again, which is another rejection. But if it breaks out here and establishes support, then it'll come up to the 400 EMA, and then it has to make a decision. Are we going to continue to break out here, or are we going to reject the 400 EMA? And that's something we don't know. If we knew that, we all be rich. So we have to just play it, play it safe. And you, as a scalper, you're gonna trade, you're gonna sell the breakouts because you know it's gonna retest. It's gonna retest the 200 EMA. Boom, it established support. It's breaking out again. You buy calls again, and then you sell the 400 EMA because it's gonna reject. It's gonna go support. It's gonna decide to break out, then it breaks out here. So if you are scalping, this is what you do. If you're swing trading, you're buying, further expiration dates out, 2 weeks to a month. If you're scalping, you're buying. If you're scalping, you're buying weeklies. So, and we'll see. We'll see.
I think that answers my other question of I wrote down a couple questions. So like when you're swinging, like do you ever swing like same week expiration dates or no? Are you swinging a couple weeks out?
You can, if you know the structure that it's moving in. So you gotta look at it 5 days in a week. If you buy a weekly, you want to do that Monday and Tuesday. So you could buy a weekly option Monday. You can buy a weekly option Tuesday. Advanced trader can buy it Wednesday. But really, you should be buying on Wednesday. You should probably start looking at buying next week if you're swing trading.
Okay.
Now you're running a risk because those options will end up equal to zero
with the data.
Yeah, because of the time expiration is going to end on Friday.
Yeah.
So it's going to end at zero, and then on Friday, a lot of people are trading zero DTEs, which are just really super scalping, and everything like that. It's not recommended, but hey, we like that gamblers take this and all that. But so you erase all this, and you're talking about at what point can I know to swing trade? If this was a Monday here. Last week, it rallied up higher, all day higher. And now you're on a Monday and it starts reversing down below what? The structure, right? So you do this pattern here, pre-market, because this happened as pre-market. You drew this pattern. So you do this channel, okay? Because that's the data is, okay, we're in a flag. It can break out. We're in this channel, which is like a bull flag. But if we break down, then we're breaking down the structure and we could probably buy puts. So we break down this chart pattern here, you're buying puts because it's also breaking down the 21 EMA. And then what's your target? Going to be the 50-day or the 400-day EMA, which is the 50 is the green, the pink is the 400. And that's just you're going to memorize color schemes. I've been using these color schemes for years, so I just know. And you're going to buy puts. Now, as the market is totally curling over, you notice how the EMAs are starting to cross down on each other? Yeah, all these are trying to cross down on each other. And you bought the breakout of the pattern, which is confluent with the 21 EMA breakdown. And now you're looking for an exit, and you just marked up that I'm going to exit here in this area because that's the last time that it has support. Also confluent with the 400 EMA. So I'm going to be selling right in this area right here. But if you want to swing this, you can't day trade because you have too many. You have day trades, like a 3-day trade. If you're a pattern day trader, you can't day trade because you don't want to give it up. Then if you could see that this is moving to the opposite side, once it starts curling down to the opposite side, and you see it breaking previous structure, then you can probably have a high probability of chance of swinging into the next day. And look at the next day, it dropped down even further, and it had a bounce here. Why? Because this was also another demand zone area, right? So it bounced back up, made an attempt, it rejected off the 400 EMA and continued back down. But ultimately, look at the 21 EMA. You see how it just came down and the price rejected off of it, the orange, rejected again and rejected again. So the 21 EMA is a very well respected moving average. Industry uses it, 21 EMA, and this stock is obviously in a downtrend. So looking at the hourly time frame, we know that it could bounce or move sideways to the 21 EMA, and it could reject again here. So there's knowing how the market's moving, it will allow you to stay in a trade longer. Okay, same thing for the uptrend. You know how this is like going sideways for a little while? Yeah, this whole thing was just sideways. So, but during a sideways movement, it eventually started breaking to the upside. So it started breaking previous structures here. It started breaking here at this level, this last resistance, and this level last resistance. So it just shows you that the market's bullish because it's breaking, the price is breaking its previous resistance points, supply zones. This previous supply zone, this previous supply zone, right?
Mhm.
Yeah. So this allows you to keep staying in the trade longer. Is that it's breaking and achieving marks that were previously denied. It's just so many ways to say it. You could say supply zone, you could say resistant, you could say, you know, it's just however you want to interpret it. You know, whatever language you want to use, it's all the same. As long as you notice what's happening here, that these prices is trying to break up above. And once it breaks above, it's bullish.
What kind of candles are you using right there? Are you using the high,
Oh, these are just regular candles.
regular candles? Okay.
Yeah, Hakanashi candles are these ones right here.
Yeah, I
Yeah.
normally use that one. And then I see some of you guys are talking about the gap, and I'm like, I don't see a gap here on this candle view. So
That's the problem I found with Hakanashi candles, is that because it's a formula, the Japanese formula is used to assume the trend. If the trend is moving up, the candles will automatically turn green and show the trend. So it gets rid of the noise for you. But in the aspect of a gap fill, it will also not show you a gap fill too.
yeah.
And gap fills are important for us to know because those gaps get filled a lot. So we always want to know where the gaps are at. We're always going to know that when it's going to fill and reverse there, or when it's going to fill to the bottom and reverse back up, because sometimes they just snap back. As soon as a gap fills to the top, it'll snap and reverse back down, vice versa. So that's why it's hard for me to use Hakanashi candles, but it is easy to know when there's a trend change as long as you follow the Hakanashi rules. Because if you're going to be a Hakanashi trader, then there's rules to it. You know, because there's different types of candles. You have these doji candles here, which are no entry, no exit candles. And then once you get 1 to 2 engulfing red candles, you're going to sell. Then you, and doji candles, you do nothing. But once you get 1 to 2 bullish green candles, then you're going to buy again. And you don't get out into this bearish golfing red candle after a doji candle. So
right there, kind of like how it is up top at like the 12 o'clock mark time frame. Once it goes, all those green candles, then goes red.
Oh, you're talking about up here?
Yeah.
Yeah,
Like
yeah. So you enter. So obviously you don't just use trade Hakanashi only. You use other indicators kind of help you out. So once this starts breaking 21 EMA, you have a doji here. You have a golfing green, second golfing green, entry candle according to the Hakanashi rules. So you enter that candle, you don't get out until you get a red doji candle close, followed by a bearish engulfing candle, which is here. So you'll be closing the position here.
Okay.
Okay. So there's like a whole guide on how to read Hakanashi that I studied for years when I trade cryptocurrency. And it's really nice.
Did not know that.
Yeah.
Probably gonna read up on that.
Mm-hmm. Yeah, I'll send you the guide after this. It's really nice. So, but and that's what I do for backtesting, and that's what I do on the weekends. So I already know that going to MU, I know that there's going to be, and you can't be one sided. You can't be like, oh, this thing's just going to crash and burn, and that's a problem why people lose money, is because they only think that the stock's going to go up. Just like those GME traders, people trading the meme stocks are like, oh yeah, I went to 200 and rejected, but it's going to go back up. It's going to go back up. $40 later, it's already down. They're like, oh man, it's still going to go back up. And you're just going to lose all your money and get everything back that you got, because you're just one-sided. You have to have your bullish sentiment and you have to have your bearish sentiment. Okay, we know that right now, according to past data, this has rejected the 21 EMA. So we're going to assume that when it gets to the price point around $76, $0.80 that it could potentially reject here, which is also around where the previous rejection happened, which is here at 76.35. So this orange line, the 21 EMA, gets to the and meets up with this rejection, likely it could reject. You know. Also, the same goes for this point of resistance where the price stopped moving up. You know, if the price of this 200 EMA comes down and matches it, it can be the very well the strength that to push the stock back down. And to push the stock back down, then you buy puts with these targets here, these exit targets down here and here, here and here. You X out the trade. But if we get over these humps, then we know that, hey, if we get above 76.53, which is 200 EMA, we'll buy calls if the market holds up, and we'll push to move to the 400 EMA or this previous resistance here. So you're just giving yourself parameters on which to enter calls and enter puts, and that's how you're planning. You're planning for this. So you're just planning your trade up and down either way. You're not biased about one way direction.
Okay. For MU, I see it's rejected off of the, was that the 200 EMA for you? The red?
Yes.
Red.
Yes, on the 5-minute time frame, rejected here, 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 here.
Okay.
I have to open.
All right. Dang, that's a lot.
Yeah, it's a lot, but once you start testing this all the time, you just regurgitate everything that I'm saying, and it just comes natural to you. And, you know, you're like, okay, back tests. We know these facts based on back testing, based on your EMA levels, based on your previous structural levels. This how MU moves. It's going to be different for AMD. It's going to be different for Boeing. It's going to be different for Tesla. Every stock's going to move differently. You know, just like a car. You got a Subaru, right? You got a, what kind of car you got?
The WRX.
Yeah, so you got a WRX, but you got a WRX, you got an STI, you know, you got a wagon. Like, it's the same brand, but Subaru, but the different models, the different engines, they're gonna move differently. They're gonna move faster, they're gonna move slower.
That's true.
And that's what it is for the stocks. You know, you just got to know how they move. MU moves fast, it moves violent, it moves all the time. We're always trading MU. Always, because look how it moves. Up and down all the time. And when it crashes and burns, it burns. When it spikes, you know. So it's one of our top stocks we always trade all the time. And that's why I use it as an example in this training session. And that's it for back testing, is just these things. And that's all there is to it. It's multi-time frame analysis based on SR flips, based on EMAs, draw your patterns. Talk about a little bit about MACD and RSI. So here's your RSI and here's your MACD. I like to use these for like momentum. So the RSI moves, relative strength index, moves a little bit faster, but the idea is that when the RSI moves below this purple range, this purple zone is a no trade zone. So when you get this RSI moving down into here, this area, you know that the stock is oversold. Okay. Now you just don't trade RSI only, you'll get wrecked, because you can see that's going up, down, and this price is still going down, right?
Yeah.
So you couple it with MACD. MACD is also another momentum indicator, and these are lagging behind. These react to the price. They're not a leading indicator. These react to the price. Okay. So, but as the price is coming down, these are starting to show the momentum shift is starting to happen. And when this moves back up and this curls up and this moves back up to the upside, you know that the price is soon going to reverse here, because this zero line is the point where it turns from bullish to bearish. It's
okay.
like a confirmation point. You see that, you see how the dotted line comes up to this area right here?
Yeah.
Yeah. So this is like divergence. So if you don't know about convergence, divergence, that's what MACD stands for. Moving average convergence, divergences. So you're looking for the divergences so that you can know when to exit before the reversal happens. So as this is coming up, you know that you got the strong move down, this strong move down RSI, strong move down MACD. But as this price is starting to come up, the momentum's trying to shift to the upside, trying to shift to the upside. So as it's flowing up, you're just kind of starting to start scaling out. If I bought 10 contracts on MU, you're going to sell 50% here at this reversal. It comes back down, a little bit greens up, you're going to sell 2 more. And then you know that looking at your MACD, as soon as it crosses the 0 line above, now your momentum's bullish, which you can see that if you tie up the moment that the MACD hits the 0 line, you're in this area where you have an 8 to 21 EMA cross above. And now the market was bullish the rest of the day. You see that?
Yeah.
Yeah. So we use these as a momentum trend change, and it's a good indicator to use. So that's just another tool in your backpack that you put in there and add to your charts, and to help you decide on which direction is going to go.
I've used the MACD and the RSI before, but I never knew in depth of like the 0 line of what it represented and stuff like that. And I knew not to trade in the purple area, but now I completely understand it. Or I feel like I have a better understanding.
It's like a whole class because you have the MACD and you have the signal line. So the MACD on here, it turns red when it's going down, and then at the point it crosses the yellow signal line and turns green.
Okay.
You're gonna cross it down, turns green. Then you have the histograms. The histograms will hit a point red, and once it starts turning yellow, you know that the momentum is shifting to the upside here. And then once the histograms are green, then it just helps you identify like a future move. So a divergence in the price, and it has all these different settings here. So, but yeah, MACD is really good for helping you plan, because you know if you keep thinking that this thing is going to go down and you're just reversing, then you lose all the money that you made here. You're giving it all back.
Yeah.
So at some point you got to apply this to your rules. Like, hey, if I made 100% down here, I'll willing to risk 20% of that to see if we can move down further. But once it gets down, once you give back 20% of your profit, you still made 80%. So you need to sell it. So you're putting stop loss on your profits. Or when you know that this breaks above previous structure, you're going to get out of the trade, because now you're coming down, up, down, up, down. Now the move has gone bullish, up, down, breaks, back up. So it already broke previous structure. Remember we talked about earlier, once the price breaks a previous structure and holds, that's it. That's it. It's time to get out of the trade. So you can see just on Friday how this respected the structure. It reversed here, went up, it teeter-totted on the resistance point here. See how it kind of messed around and consolidated for a little bit?
Yep.
For about 20 minutes. All of a sudden, boom, breakout. Because it respected this previous structure. This whole consolidation cluster here is respected. And that's why you get the same consolidation structure right here. You know what they say? Consolidation under resistance is bullish. This is the last past data that was a fact that this right here is consolidation area. So you have to know that this is consolidation area here. And once it breaks out, this thing is all out bullish, and you can buy calls. And where you're going to exit?
Next resistance level?
Next resistance level. 50 EMA, 100 EMA, 200 EMA. If you're EMA trading, if you're playing based on previous structure, you're going to sell here. You're going to sell a little bit here. You're going to sell a little bit here, a little bit here, you know?
Yeah.
So it's all on your trade plan. You're going to have 2 profit targets. You're going to have 3 profit targets, but you can't have you cannot take the whole trade if you buy only one of something because you can't afford it. If you buy only one Tesla, once you're out, you're out. But if you have 2 Teslas and you enter here in the break, you can get out here and you can get out here at the end of the day. And you caught the whole move today, day trading. Anything else?
No, that's kind of all the questions I had.
Yeah. So I'll give you this recording. We can you can view it back, and if you have any questions after that, you just let me know. But yeah.